Investing isn't just about picking stocks or stashing cash in a savings account. A well-balanced portfolio consists of different asset classes, each with its own potential for growth, risk, and stability. If you want to build long-term wealth while protecting yourself from market downturns, understanding these asset classes is essential. 1. Equities, ownership in businesses. Equities, or stocks, represent partial ownership in a company. When you buy a share, you're buying a piece of that business. As the company grows, the value of your investment increases. Stocks are known for their high return potential, but they also come with volatility. Some companies pay dividends, providing investors with regular income. While stocks can experience sharp price fluctuations, they have historically outperformed most other investments over the long term. Whether you're looking for growth, income, or a mix of both, equities should be a core part of your portfolio. 2. Fixed income, stability and predictable returns. Fixed income investments, like bonds, provide a steady and predictable stream of income. When you purchase a bond, you're essentially lending money to a corporation or government in exchange for interest payments over time. At the end of the bond's term, you get your initial investment back. Bonds are generally less volatile than stocks, making them a great option for those who want to reduce risk. They can act as a cushion during market downturns, helping stabilize your portfolio. However, because of their lower risk, bonds also tend to offer lower returns compared to stocks. 3. Real assets, tangible investments with long-term value. Real assets include real estate, commodities, and infrastructure. These are physical investments that can provide long-term growth and hedge against inflation. Real estate, for example, generates income through rental properties and appreciates over time. Commodities like gold and oil are often seen as safe haven investments during economic uncertainty. Infrastructure investments, such as toll roads, airports, and energy projects, provide essential services that generate steady cash flow. While real assets can be lucrative, they require careful management and often come with higher costs compared to stocks and bonds. However, they add diversification and protect against inflation, making them a valuable addition to any investment strategy. 4. Cash and cash equivalents, liquidity and security. Cash and its equivalents such as savings accounts, money market funds, and treasury bills, provide liquidity and security. These assets are the safest place to store money you may need in the short term. Although cash doesn't generate high returns, it plays an important role in financial planning. An emergency fund, for example, should be kept in cash or highly liquid assets to ensure quick access during unexpected events. Holding cash also allows investors to seize opportunities when markets dip. However, there is one major downside: inflation. Over time, the purchasing power of cash declines, meaning too much exposure to this asset class can reduce overall returns. 5. Alternative investments, high-risk, high-reward strategies. Alternative investments include cryptocurrencies, hedge funds, venture capital, and private equity. These assets don't fit into traditional categories but offer unique opportunities for growth. Cryptocurrencies like Bitcoin and Ethereum have created massive wealth for early investors, but they come with extreme volatility. Hedge funds and private equity investments allow wealthy investors to access exclusive high-growth opportunities. Venture capital funds early-stage companies, which can lead to significant gains or total losses. Alternative investments can be risky, complex, and less liquid than traditional assets, but they provide diversification and potential for high returns. They are best suited for experienced investors willing to take on greater uncertainty in pursuit of higher gains. Why diversification matters? Each asset class serves a different purpose in an investment portfolio. Stocks drive growth, bonds provide stability, real assets hedge against inflation, cash ensures liquidity, and alternative investments offer high-risk, high-reward opportunities. A balanced portfolio spreads investments across multiple asset classes to reduce risk and maximize returns. For example, during a stock market crash, bonds and real estate might hold their value. If inflation spikes, commodities like gold could act as a safeguard. Diversification ensures that no single event wipes out your entire portfolio. Understanding these 5 major asset classes is the foundation of smart investing. Whether you're aiming for high returns, stability, or protection against inflation, allocating your money wisely across different asset classes will help you achieve long-term financial success. Which asset class do you focus on the most? Let us know in the comments.